As we head into 2021 and as we evaluate our investment options, two real estate asset classes in particular, self storage and manufactured home parks, are poised to be the most solid investments due to its market resilience. My next guest, Ryan Smith, will explain why you should be investing in these assets next on the WTRE show.
Welcome to the Wealth Through Real Estate Investing Podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and to reach the lifestyle you always wanted. And now, your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing Show. This is your host, Dwaine Clarke. Today we have Ryan Smith. Ryan is a partner with Elevation Capital Group. Ryan, thank you so much for joining us on the show. And how you doing, my friend?
I'm doing great. Thanks for the time. It's nice to be able to talk with you today.
Absolutely. Yeah, really looking forward to this discussion. Kind of what I mentioned in my intro was kind of talking about, looking at different investment options as we head in towards 2021. We're trying to kind of look where we're going to be parking our capital, and you guys are heavily invested in self-storage and mobile home parks. Can you kind of talk about, why you guys chose as an asset class, and kind of talk about, why investors should consider that as a an investment option?
Sure. So it kind of, I guess the answer relates to our story, or my story. My wife and I started the firm many years ago, but to make it real short, we had started a software company that we had made quite a bit of money from. And so when we started in the business, we were deploying our own capital for our own benefit. So we really were looking for four things. We wanted cash flow. We wanted capital appreciation for the purpose of creating wealth. We wanted tax benefits. And we wanted, cycle resiliency, or, people refer to it as low beta or non-correlation to the broader market. So those were what we wanted for ourselves. And so when you look back now, talking from the point of today, when you look back over the last 20 years, the two best performing asset classes for net operating income growth year over year, both the quantity of growth but also the quality of growth in terms of volatility around what growth has been. The two best performing asset classes over the last 20 years are self-storage and mobile home parks. And ironically, they're tied at 4.3% per year growth for first. And so anyway, that's what we were looking for. And we started building a portfolio of mobile home parks and storage facilities for ourselves. So it's a long answer, but hopefully that's helpful.
Yeah, absolutely. And then we were starting to kind of see it. It doesn't seem kind of like the most sexiest investment vehicle, but it works. And especially now that you're seeing kind of like the larger institutional investors like Blackstone and all these guys getting into it, people are kind of starting to was like, oh, what is this asset class? Have you starting to see more kind of traction, and has it kind of alter any kind of like your pricing and things that you see in there, is like increasing like price per unit that since you're seeing larger and more investors get into the space?
Sure. Yeah, I think as a function of kind of, I'll say, monetary and fiscal policy, there's a lot of money in the market today looking for a home. There's a lot of investors hunting for yield. So across all boards, all fronts, really all asset classes, prices are high, cap rates are low relative to where they've been historically. So the same is certainly true for mobile home parks. I had actually in our conference room here this morning, had a large broker in the mobile home park space who is, he was saying he's seeing closings occur in the 1 and 2 cap rate range on certain assets.
Whoa.
Which is just to give you
Wow.
just to kind of maybe shock your system with that comment for a second. That's certainly not the average, but the point is, cap rates, especially, and there's a whole interesting discussion here, but I've seen a lot of cap rate compression, in some cases more so on the lower qualities, as more and more, capital is formed around crowdfunding, and typically they go after the perception of higher cash flowing assets. So in the mobile home park space, there's an increased amount of capital flowing to the lower qualities. And so we've seen quite a bit of cap compression on the lower quality assets. And in some cases more than even the higher quality, which is interesting.
Mm. And as far as kind of like, I know you guys have a pretty large portfolio. What are kind of like some targets for you guys heading into 2020? I know people are kind of looking at getting involved in all different types of real estate asset classes. But what's your kind of company's targets for this year and beyond?
Yeah, so we're really looking to do the same thing. I mean, we don't have a growth for the sake of growth mindset. Because to a degree, anything done for its own purposes is almost self-defeating. So, for us, we know what we like, we know what we're looking for, and in as much as we see that in the marketplace, we'll move forward. And if that means we buy nothing for a year, that's perfect. That's a perfectly fine year. If we buy quite a bit, then that's fine too. So, kind of as we're starting the year at this point, we have a mobile home park under contract in the Washington, D.C. metro. That'll probably close in the next month or two. We have a pretty sizable storage asset we're hunting down. We think we might be able to get it. So, so far 2021 is off to a really good start. And we think that we think at this point it'll be a pretty good year.
So you mentioned Washington, D.C. and other parks. So what's kind of like some characteristics of some markets that you guys invest in? What areas are you bullish on?
And I'm sorry, it broke up just for a second on me. What was the question?
You had mentioned that a working on acquisition in Washington, D.C. Can you kind of talk about kind of the markets that you like and what are you bullish on?
Yeah, so we're a national firm. We currently own in more roughly 30 states, and I say that to say we want to own. I guess to be specific, we're broad in focus, but to be specific with regards to an answer to the question. We want to buy in markets that we think 10, 20 years from now will be assets we would want to own in at that point in time. So we're long-term holders of real estate. So, we like several markets in Texas, the obvious ones, Dallas, Austin, Houston, San Antonio. We like Denver, Colorado, Phoenix. We like the DC metro. We like Florida quite a bit. And then there's there's certain other markets we like, to a certain degree, like Philadelphia and New Jersey. We try to stay out of New York. There's also considerations by asset class. So, for example, the southeastern United States, when you're looking at Mississippi, Louisiana, parts of Tennessee, Arkansas, Georgia, Alabama, and the panhandle of Florida, has a risk we've identified that we consider, we call it stratification risk, which to your viewers, or listeners, if you struggle with sleep, just, think about this and that this may cure what ails you. But in short, basically what it is when in the mobile home park space, you want separation between asset classes. You don't want a mobile home community to be directly competed with single family housing or apartments or other product types. So you want clear and distinct segmentation between asset classes. So in that geographic area that I was just describing, you can buy a house in some cases for $40,000. And your all-in payment may be $500. So that's pretty close to what a mobile home would rent for. So in short, we want to buy in markets where there's clear segmentation. So we wouldn't likely buy in the Southeast in terms of mobile home parks. We wouldn't likely buy in the New England areas because of population exodus. People are leaving. And then lastly, when you look at regulatory risk, if you look at the Pacific Northwest with, Washington, Oregon, California, those kind of states where there's adverse tenant landlord laws and rent controls, those are just some things we would look to avoid.
Awesome. And then even you had mentioned kind of like rent control. Does that flows down to the mobile home park sector as well?
It does, yeah.
Wow.
It pretty much covers. It's a little bit more nuanced. So for example, in California, I have friends that own mobile home parks out there and have done quite fine. The way they do it there is generally our model is when we're talking about mobile home parks, we do not want to own the homes. We just want to own the land. It's
Gotcha.
Basically a residential ground lease. So we own the dirt, but not the homes. But what they do in California oftentimes is you'll find the park owns all the homes. because in some instances, the rent control is on the income from the dirt, but does not apply to the income from the home. So in that case, a property owner out there would want to own all the homes and rent the homes out, because then they can escalate the rents on the homes, but the land rent is capped.
Yeah, it makes sense. Absolutely.
So there's a lot of ways you can go with it, but yeah.
Oh, okay, okay. And as far as you guys kind of mainly operate as funds, to be able to invest into multiple properties. Can you kind of tell us the advantage of you guys to choose a fund vehicle rather than kind of like a direct to asset type of vehicle?
Sure. And I'll add one other, I guess, point of distinction. So there's a fund model versus a direct to asset model. But then the size of the fund also, we think, matters. So, and I'll add that as a point as well.
Great.
So, just kind of off the top, probably the obvious things, which are, one, when like we're on fund 8, this is our 8th fund. We're not overly creative with our naming schemes, and we do not have a marketing department. We have fund 1, 2, 3, 4, and now we're at 8. But in short, so fund 8, we may acquire, call it 20 assets. So if somebody is investing in fund 8 versus another single asset, there's more diversification with fund 8, in that their investment would be spread across 20 assets. So there's asset-based diversification, there's asset class diversification, because it would be spread across mobile home parks and self-storage. There's also geographic diversification from a geographic lens. And there's some other points of benefit, beyond knowledge and skill set, and we think we do a good job in some of those things. One of the other, I guess, points to mention is one of the benefits of a fund, and especially a fund that is larger. What I mean by this is, let's say our second fund was a $5 million fund. Our last fund was a $140 million fund. Okay, and it's not just more or bigger for the sake of more or bigger, because again, to a degree, that's self-defeating, and that's not our goal. So the question is, why is, let's say, a $150 million fund, why might it be better in some ways than a smaller fund? And one added advantage you have is you have a better balance sheet. You have a bigger and potentially better balance sheet, which allows you to obtain, in some cases, types of debt financing, both secured and unsecured, that you might not be able to obtain on a one-off asset or a smaller fund even. So it's why we structure our funds as we do, is the hope is that it unlocks potential opportunities that are not available elsewhere. And that opportunity should find its way as a benefit to investors.
Yeah, very well said. Awesome. And as far as I know we kind of got directly into the topic, but you had mentioned that you and your partner kind of came from software backgrounds and things like that. Can you kind of talk about your entrepreneurial background and how it led into your new venture of real estate investing?
Yeah, it's funny. So I'll summarize it by this. I don't think I've ever had a period in my life where I've sat still. So, I'm a highly curious person. So I learned to code at 8 years old. My parents were in real estate. Every weekend I was at a property, scraping, digging, trenching, replacing, basically my job was to do the job they didn't want to do, which is, a perfectly fine role for any child, I think. So, in short, I loved it. I loved the work. I like to sweat. I like to get my hands dirty. And then at 8, I started coding. I was fascinated by computers, and I'd write software for, pretty much, it was an odd thing. I'd go to a business, I'd walk into a business, sometimes with my parents, sometimes not. And if I saw something that was wrong that software can solve, I'd go home, I'd write an application, put it on a disk, take it to the business and say, hey, I think this will help you. So I would write software for anybody and everybody. So as a teenager, I did my father's underwriting. So when my dad would buy a property, I would do his analysis, his cash on cash, MOIC, IRRs, all of his modeling I would do. So one summer I spent 3 months, which is a big deal for a teenager to spend 3 months of your time. And I spent 3 months of my time writing an application that my dad could use to model his own investments. And so anyway, that ended up becoming a roughly 60,000 line coded, application, line of code application, which I eventually sold off and, made quite a bit of money from this little application I built to help my dad in his business. So in short, I mean, pretty much from the day I was born, we've been working, and my wife has a similar story, but we've started a number of companies, we've sold companies, we've done a lot of different things, and the one common thread has been real estate. So it's not, I couldn't tell you we did all of these wrong things and then found real estate, and it's a kind of a Graceland moment. Real estate has been the common thread all throughout, but being as involved in real estate as we've had for so long, I still haven't found a problem with doing it on a permanent basis. I still haven't found that, the aha, I made the wrong choice. It's still the right choice for me.
Yeah, definitely. Yeah, it's like I said, something you can continue doing on. So yeah, very well. Thanks for sharing that. And just kind of learn a little bit more about you, and then kind of what's like run us through a typical work day for you, and do you have any special morning routines?
My wife and I make a good team. My wife is, and I'll explain it. My wife is incredible. If you ever have her on your show, you'll regret having me on your show. So we have 4 kids, 8, 6, 4, and 2. All 4 were born within 8 days, 2 years apart. So if you want to know about routine and structure, that'll tell you more about my wife than anything. I'm intentional about not being intentional in some aspects. I like the freedom to pursue relationship and build relationships with people, and sometimes that can't be structured. So so typically, I mean, we're both up at 5 a.m. We do our workout, we take care of the kids, and I mean, we both have our own routines, but generally I'm in the office at 8 a.m. and depending on the day, maybe here at 6 or 7. But I would say part of our, for us, we're not an office company, we're a real estate company. So I don't view my job as staying in the office here and looking out my window, imagining what the properties are doing wherever they are. We actually physically walk every property twice a year, nationwide. So we're very, very much believers of boots on the ground. So the majority of my time is out in the field and not in the office.
Awesome. And between your partner and your workers there, do you guys use any tools or resources that help you guys be more productive?
Oh man, yeah. I mean, there's no shortage of tools that we use. It's an amalgamation of just a number of different systems for different purposes. And I'll say philosophically, I've kind of made the decision of rather than obtaining a platform that does everything you need terribly, which is usually the case, or you go out and find the component parts that do each part well. I do the latter, not the former. So, we have a lot of different tools we use. One that was kind of interesting a number of years ago, and I actually find myself still using it, is an artificial intelligence assistant. So for scheduling appointments and finding calendars that sync and all of that, there's a service called X.AI, and that's a pretty interesting service. So if somebody were to email me and say, hey, I'd like to set up a call with you or whatnot, I can just reply and say, hey, Amy, and copy this artificial intelligence bot, which has an email address at my organization. It's amy@elevationcg.com. So I send an email to Amy saying, hey, coordinate this. Amy will, in full conversation, dialogue with the person, find, calendar that works for them, me, put it on my calendar, and I don't do anything. So
That's
we've
awesome.
actually had people call in and say, just want to tell Amy she did a great job. So it's pretty funny.
Well, yeah, don't tell her because she's gonna want a salary. So it's and
Exactly.
I always ask this question to all of our guests. Is this something that I do a lot and always think about is gratitude. And it seemed like you had a very blessed life. You have great parents, great wife, great support team. You can tell us what you're grateful for.
Oh yeah, answer is yes. There's no limit to that. I mean, there's the simple reality that I could have been born at another time in another place and another set of circumstances. And, there's nothing that I did to be born in an environment that incubated opportunity. That was purely gifted and given. So what therefore is mine to own? The answer to me is none. So yeah, I'm grateful for all that.
Awesome. And we'll make sure to have your information in the show notes so everyone can kind of get in contact with you, learn about your funds and kind of your investment thesis. Can you kind of share with us how do we get in contact with you?
Sure. If you're struggling with sleep, call anytime, and we'll try to work on that. No, my phone number is my direct line is 407-602-7662. Our website is elevationfund.com. And my email is ryan@elevationcg.com.
Awesome. Ryan, it was a pleasure having you on. Like I said, love learning about these different asset classes because as we're looking to kind of, get into some investments and kind of really protect our portfolio and definitely, self-storage and mobile home parks, I think is a big hit. I appreciate you sharing the knowledge that you have. Continued success to you and your family, and I look forward to connecting you with again soon.
Sounds great. Thanks for your time.
All right. Take care, my friend.
All right. See you, buddy.
Bye-bye. Hey there, this is Dwaine Clarke, your host of the Wealth Through Real Estate Investing Show. I want to thank you again for tuning in and hope you're enjoying this valuable content. While I got you for a quick minute, I wanted to send you an invitation to join our growing investor community. It's called the Passive Investors Club. It's a group of like-minded individuals like you who are seeking financial freedom and to build true wealth through passive investing in commercial real estate. We take a totally different approach to investing that is opposite, that is pushed by the financial advisors and what we see in the mainstream media. We like to invest in real assets that we can touch and understand and that are not subject to the wild swings of the financial markets. We don't want to be part of the herd who pursues the traditional route, leaving our financial future to Wall Street. So if you're interested in joining our group and to sharing resources and opportunities, then go to passiveinvestorsclub.com/join. Joining the club is completely free and there's no obligation. And all our members receive our free Passive Investors course along with tons of resources and content. So again, passiveinvestorsclub.com/join.